Double-entry bookkeeping, in accounting, is a system of bookkeeping so named because every entry to an account requires a corresponding and opposite entry to a different account. For instance, recording earnings of $100 would require making two entries, a debit entry of $100 to an account called cash, and a credit entry to an account called income. The earliest known written description of double-entry accounting comes from Franciscan friar Luca Pacioli. In deciding which account has to be debited and which account has to be credited, the golden rules of accounting are used. This is also accomplished using the accounting equation, equity equals assets liabilities. The accounting equation serves as an error detection tool. If at any point the sum of debits for all accounts does not equal the corresponding sum of credits for all accounts, an error has occurred. It follows that the sum of debits and the sum of the credits must be equal in value. Double-entry bookkeeping is not a guarantee that no errors have been made. For example, the wrong ledger account may have been debited or credited, or the entry is completely reversed. Accounting entries. In the double-entry accounting system, two accounting entries are required to record each financial transaction. These entries may occur in asset, liability, income, expense, or capital accounts. Recording of a debit amount to one or more accounts and an equal credit amount to one or more accounts results in total debits being equal to total credits for all accounts in the general ledger. If the accounting entries are recorded without error, the aggregate balance of all accounts having positive balances will be equal to the aggregate balance of all accounts having negative balances. Accounting entries that debit and credit related accounts typically include the same date and identifying code in both accounts, so that in case of error, each debit and credit can be traced back to a journal and transaction source document, thus preserving an audit trail. The rules for formulating accounting entries are known as golden rules of accounting. The accounting entries are recorded in the books of accounts. Regardless of which accounts and how many are impacted by a given transaction, the fundamental accounting equation A equals L plus OE will hold, that is assets equals liabilities plus owner's equity. History. The earliest extant accounting records that follow the modern double-entry form are those of Amatino Manucci, a Florentine merchant at the end of the 13th century. Manucci was employed by the Farolfi firm, and the firm's ledger of 1299 to 1300 evidences full double-entry bookkeeping. Giovannino Farolfi and Company were a firm of Florentine merchants whose head office was in now registered trademark Mes, who also acted as money lenders to the Archbishop of Arles, their most important customer. Some sources suggest that Giovanni di Bicci de' Medici introduced this method for the Medici Bank in the 14th century. However, the oldest discovered record of a complete double-entry system is the Messeri accounts of the Republic of Genoa in 1340. The Messeri accounts contain debits and credits journalized in a bilateral form, and contains balances carried forward from the preceding year, and therefore enjoy general recognition as a double-entry system. By the end of the 15th century, the bankers and merchants of Florence, Genoa, Venice and La One Quarterbeck used this system widely. Luca Pacioli, a Franciscan friar and collaborator of Leonardo da Vinci, first codified the system in his mathematics textbook Summa di Arithmetica, Geometria, Proportioni e Proporzionalità, published in Venice in 1494. Pacioli is often called the father of accounting, because he was the first to publish a detailed description of the double-entry system, thus enabling others to study and use it. There is however controversy among scholars lately that Benedetto Cotragli wrote the first manual on a double-entry bookkeeping system in his 1458 treatise della Meritura e del Mercante Perfetto. Approaches. There are two different ways to memorize the effects of debits and credits on accounts in the double-entry system of bookkeeping. They are the traditional approach and the accounting equation approach. Irrespective of the approach used, the effect on the books of accounts remains the same, with two aspects in each of the transactions. Traditional approach. Following the traditional approach, accounts are classified as real, personal, and nominal accounts. Real accounts are accounts relating to assets and liabilities, including the capital account of the owners. Personal accounts are accounts relating to persons or organizations with whom the business has transactions and will mainly consist of accounts of debtors and creditors. Nominal accounts are revenue, expenses, gains, and losses. Transactions are entered in the books of accounts by applying the following golden rules of accounting: personal account, debit the receiver and credit the giver; real account, debit what comes in and credit what goes out; nominal account, debit all expenses and losses and credit all incomes and gains. Accounting equation approach. This approach is also called the American approach. Under this approach, transactions are recorded based on the accounting equation, that is, assets equals liabilities plus capital. The accounting equation is a statement of equality between the debits and the credits. The rules of debit and credit depend on the nature of an account. For the purpose of the accounting equation approach, all the accounts are classified into the following 5 types: assets, liabilities, income revenues, expenses, or capital gains losses. If there is an increase or decrease in one account, there will be equal decrease or increase in another account. There may be equal increases to both accounts, depending on what kind of accounts they are. There may also be equal decreases to both accounts. Accordingly, the following rules of debit and credit in respect to the various categories of accounts can be obtained. The rules may be summarized as below: assets accounts, debit increases in assets and credit decreases in assets; capital account, credit increases in capital and debit decreases in capital; liabilities accounts, credit increases in liabilities and debit decreases in liabilities; revenues or incomes accounts, credit increases in incomes and gains and debit decreases in incomes and gains; expenses or losses accounts, debit increases in expenses and losses and credit decreases in expenses and losses. These 5 rules help learning about accounting entries and also are comparable with traditional accounting rules. Books of accounts. Each financial transaction is recorded in at least 2 different nominal ledger accounts within the financial accounting system, so that the total debits equals the total credits in the general ledger, that is the account's balance. This is a partial check that each and every transaction has been correctly recorded. The transaction is recorded as a debit entry in one account, and a credit entry in a second account. The debit entry will be recorded on the debit side of a general ledger account, and the credit entry will be recorded on the credit side of a general ledger account. If the total of the entries on the debit side of one account is greater than the total on the credit side of the same nominal account, that account is said to have a debit balance. Double entry is used only in nominal ledgers. It is not used in daybooks, which normally do not form part of the nominal ledger system. The information from the daybooks will be used in the nominal ledger, and it is the nominal ledgers that will ensure the integrity of the resulting financial information created from the daybooks. The reason for this is to limit the number of entries in the nominal ledger. Entries in the daybooks can be totaled before they are entered in the nominal ledger. If there are only a relatively small number of transactions, it may be simpler instead to treat the daybooks as an integral part of the nominal ledger and thus of the double entry system. However, as can be seen from the examples of daybooks shown below, it is still necessary to check, within each daybook, that the postings from the daybook balance. The double entry system uses nominal ledger accounts. From these nominal ledger accounts, a trial balance can be created. The trial balance lists all the nominal ledger account balances. The list is split into 2 columns, with debit balances placed in the left-hand column and credit balances placed in the right-hand column. Another column will contain the name of the nominal ledger account describing what each value is for. The total of the debit column must equal the total of the credit column. Debits and credits. Double entry bookkeeping is governed by the accounting equation. If revenue equals expenses, the following equation must be true: assets equals liabilities plus equity. For the accounts to remain in balance, a change in one account must be matched with a change in another account. These changes are made by debits and credits to the accounts. Note that the usage of these terms in accounting is not identical to their everyday usage. Whether one uses a debit or credit to increase or decrease an account depends on the normal balance of the account. Assets, expenses, and drawings accounts have a normal balance of debit. Liability, revenue, and capital accounts have a normal balance of credit. On a general ledger, debits are recorded on the left side and credits on the right side for each account. since the accounts must always balance, for each transaction there will be a debit made to one or several accounts and a credit made to one or several accounts. The sum of all debits made in each day's transactions must equal the sum of all credits in those transactions. After a series of transactions, therefore, the sum of all the accounts with a debit balance will equal the sum of all the accounts with a credit balance. Debits and credits are numbers recorded as follows. Debits are recorded on the left side of a T account in a ledger. Debits increase balances in asset accounts and expense accounts and decrease balances in liability accounts, revenue accounts, and capital accounts. Credits are recorded on the right side of a T account in a ledger. Credits increase balances in liability accounts, revenue accounts, and capital accounts, and decrease balances in asset accounts and expense accounts. Debit accounts are asset and expense accounts that usually have debit balances, that is, the total debits usually exceeds the total credits in each debit account. Credit accounts are revenue accounts and liability accounts that usually have credit balances. Double entry example. In this example the following will be used: books of prime entry, also known as journals, sales invoice daybook, bank receipts daybook, cash book/sales book, return inwards daybook, return outwards daybook, purchase invoice daybook, bank payments daybook. The books of prime entry are where transactions are first recorded. They are not part of the double entry system, but may be expanded by the computer as a debit to one account and a credit to another account. For example, a cash receipts transaction may cause a debit to a cash account and a credit to an accounts receivable account. Ledger cards, customer ledger cards, supplier ledger cards, general ledger, bank account ledger, trade creditors ledger, trade debtors ledger, purchase invoice daybook. Each individual line is posted as follows. The amount value is posted as a credit to the individual supplier's ledger AC. The analysis amount is posted as a debit to the relevant general ledger AC. From example above, line 1 euro amount value 1000 is posted as a credit to the supplier's ledger AC LEO1 electricity company. Line 2 euro amount value 1600 is posted as a credit to the supplier's ledger AC WID01 widget company. The totals of each column are posted as follows. Amount total value 2600 posted as a credit to the trade creditors control AC. Electricity total value 1000 posted as a debit to the electricity general ledger AC. Widget total value 1600 posted as a debit to the widget's general ledger AC. Double entry has been observed because drive equals 2600 and CR equals 2600. Bank payments daybook. The payments book is not part of the double entry system. Keys. PI equals purchase invoice, BP equals bank payment. Each individual line is posted as follows. The amount value is posted as a debit to the individual supplier's ledger AC. The analysis amount is posted as a credit to the relevant general ledger AC. From example above, line 1 euro amount value 1000 is posted as a debit to the supplier's ledger AC LEO1 electricity company. Line 2 euro amount value 900 is posted as a debit to the supplier's ledger AC WID01 widget company. The totals of each column are posted as follows. Amount total value 2300 posted as a credit to the bank account. Trade creditors total value 1900 posted as a debit to the trade creditors control AC. Other total value 400 posted as a debit to the wages control AC. Double entry has been observed because drive equals 2300 and CR equals 2300. The daybooks are the key documents to the double entry system. From these daybooks we create the ledger accounts. Each transaction will be recorded in at least 2 ledger accounts. Supplier ledger cards, sales customers, sales daybook. Each individual line is posted as follows. The amount value is posted as a debit to the individual customer's ledger AC. The analysis amount is posted as a credit to the relevant general ledger AC. From example above, line 1 euro amount value 2500 is posted as a debit to the customer's ledger AC JJM01 JJ Manufacturing. Line 2 euro amount value 3200 is posted as a debit to the customer's ledger AC JJM01 JJ Manufacturing. The totals of each column are posted as follows. Amount total value 5,700 posted as a debit to the Trade Debtors Control AC. Sales parts total value 2,500 posted as a credit to the Sales Parts AC. Sales service total value 3,200 posted as a credit to the Sales Service AC. Double entry has been observed because drive equals 5,700 and CR equals 5,700. Customer ledger cards. Customer ledger cards are not part of the double entry system. They are for memorandum purposes only. They allow you to know the total amount an individual customer owes you. General Ledger, SDB1. Sales Invoices Daybook page 1 PDB1. Purchase Invoices Daybook page 1 BPDB1. Bank Payments Daybook page 1 BRDB1. Bank Receipts Daybook page 1. The customer's ledger cards shows the breakdown of how the Trade Debtors Control AC is made up. The Trade Debtors Control AC is the total of outstanding debtors and the customer ledger cards shows the amount due for each individual customer. The total of each individual customer account added together should equal the total in the Trade Debtors Control AC. The supplier ledger cards shows the breakdown of how the Trade Creditors Control AC is made up. The Trade Creditors Control AC is the total of outstanding creditors and the supplier's ledger cards shows the amount due for each individual supplier. The total of each individual supplier account added together should equal the total in the Trade Creditors Control AC. Each bank AC shows all the total money in and out through a bank. If you have more than one bank account for your company, you will have to maintain separate bank account ledgers in order to complete bank reconciliation statements and be able to see how much is left in each account. Bank account, unadjusted trial balance. The individual customer accounts are not to be listed in the trial balance, as the Trade Debtors Control AC is the summary of each individual customer AC. The individual supplier accounts are not to be listed in the trial balance, as the Trade Creditors Control AC is the summary of each individual supplier AC. Important note, this example is designed to show double entry. There are methods of creating a trial balance that significantly reduce the time it takes to record entries in the general ledger and trial balance. Profit and loss statement and balance sheet, see also, Nostro and Vostro accounts, single entry bookkeeping system, momentum accounting and triple entry bookkeeping, notes and references. Further reading, Gleason White, Jane. Double entry. Allen and Unwin. ISBN A978-1-74175-755-2. Soule, Jacob. The Reckoning, Financial Accountability and the Rise and Fall of Nations. Basic Books. ISBN A978-0-46503-152-8. External links, a concise explanation of the accounting equation, a double entry new cash how-to, bin counters bookkeeping tutorial, bookkeeping terms, new cash data entry concepts, the accounting adventurista double entry system.